completion of this activity, you will be able to define accounting and explain its utility in financial management. List and explain the principles and practices in accounting. Describe several methods of accounting and their applications. Elaborate on the concept of financial accounting and its significance in business. Explain what the basic books of accounts and the process of recording financial transactions is, including the role of a manual accounting system.
Definition and utility of accounting. Accounting. Definition of accounting. Accounting has been defined as the process of systematically recording, classifying, and summarizing financial transactions and events in terms of money and interpreting results thereof. Language of business. Accounting is the language of business. It involves identifying, measuring, and presenting economic information about a business in such a way that the users of the information can form an opinion about the business.
What is the purpose of maintaining books of accounts? There are several uses of recording financial transactions. Some of them are keeping track of expenses, keeping track of cash, for calculating the profit, for reconciling efforts against the profit earned. Have you ever purchased anything from a shop? For example, you are at a general store to buy a packet of biscuits. While you are waiting, look around. What do you see? Normally, what do you think must be the income and expenditure for this general store? Salary of employees, electricity expenses, purchase of goods, cleaning expenses are some examples of expenditure. Money earned from the sale of goods is the main source of income. Isn't it easy to imagine the type of expenses and income that one might have? Recording such transactions is the basis of accounting. For your practice, you may prepare a list of common sources of income and expenses for the following businesses. Business is continuous, but for accounting we use two fundamental concepts: going concern and matching concept. Going concern means there is no intention or requirement to close the business in the foreseeable future. It means the owners wants to continue the business. We divide the business into financial years for the purpose of analysis and reporting. We then match the income and expenses of one period to know whether we made a profit or incurred a loss. This is known as matching concept. Books of accounts can be maintained using two broad methods: cash basis and accrual basis. Cash basis means recording transactions on the basis of actual receipts and payments. Accrual basis means recording transactions when they become payable or receivable and not on actual receipt or payment of money. Some organizations like schools, NGOs, and small shops maintain records on cash basis. Companies, banks, and large business organizations maintain record on accrual basis. How are records maintained in accounting? At home, you may use a small notebook for recording expenses. Some people may use a mobile app to do so. Organizations, however, maintain books of accounts for each financial year. Let us take a look at what these books of accounts are. Cash book. This book contains all entries of cash or bank payments and receipts. Journal. This is used for recording transactions. Ledger. This is used to maintain the summary of similar types of transactions. For instance, ledger for salary will contain the summary of salaries paid for each month. Examples of ledger are telephone expenses, travel expenses, etc. You can make as many ledgers as you need according to your type of business. Definition of accounting. Accounting has been defined as the process of systematically recording, classifying, and summarizing financial transactions and events in terms of money and interpreting results thereof. You can maintain a cash book, a journal, and ledgers manually. However, recording transactions in all of these books accurately is time-consuming. Nowadays, there are accounting softwares that simplify the process of maintaining the books of accounts. Difference between manual and computerized accounting systems. Method of recording. In a manual accounting system, physical journals and ledgers are used for keeping records of transactions. In a computerized accounting system, computers and accounting softwares are used for keeping digital records of transactions. Method of calculation. All calculations are done manually. Here, operators record the transactions manually in a database on a computer. All calculations are done by the computer system. There is no need to calculate the balance of each account. It is automatically calculated by the system. Ledger posting. In manual accounting, the ledger is manually checked and then figures are transferred to the debit or credit side of related account through manual posting. Computerized accounting system automatically process input data and create all the ledgers because voucher entries are passed under the respective ledger accounts. Trial balance. The information regarding the balances of all accounts in the ledger is collected and the trial balance is prepared manually. A computerized accounting system prepares the trial balance automatically without requiring any manual efforts. Financial statements. Financial statements are prepared manually by carefully transferring the figures from the trial balance to the income statement and balance sheet. The system generates all the periodic financial statements as and when required. Some of the accounting software used are Tally, Vyapar, QuickBooks, Zoho Books, Busy, etc. The different software have different interfaces, but they help with essentially the same process in accounting.